A war unlike any other is unfolding at sea, not between tanks and missiles, but between ghost ships and money. While much of the world remains focused on battles on land, a critical weakness has emerged in Russia's financial system: the export of crude oil by sea. This is no longer just a territorial defense war, it's a brutal hunt targeting the Shadow Fleet, a covert network of tankers Russia uses to sustain its war machine. This battle isn't just against soldiers, it's a direct strike at Russia's financial system, where every oil tanker shipment is a lifeline. Stopping these shipments isn't merely a naval clash, it's a punch straight to Russia's economic foundation. This is a war for survival, where each barrel of oil becomes the prize and each tanker is a target for annihilation. Ukraine isn't just battling soldiers on the ground, they're fighting an entire financial empire where energy resources are transformed into military power. They are attacking the very lifeblood of the Kremlin. When these oil tankers are hit, the money flowing into Moscow's war chest stops. This war doesn't just shake the military, it threatens the very existence of Russia's economy. To grasp the significance of this target, we must dive into the sheer scale and structure of what's known as the Shadow Fleet. This covert operation has grown to over 600 vessels, a threefold increase since the invasion began. These aren't your typical commercial oil tankers operating in transparent markets. They're ghost ships, bought cheaply to bypass Western sanctions. Today, the fleet can transport around 7.5 million barrels of oil per day, a volume large enough to keep Russia's economy afloat despite G7 sanctions. The system's dependence on these ships is absolute. In just the first 9 months of 2025, 113 of these tankers used flag of convenience tactics to move 11 million tons of crude oil worth approximately $5.5 billion. This network operates like mobile ATMs for the Kremlin, funneling billions of dollars through sanction barriers straight into state coffers. The fleet is primarily made up of old hulls, vessels discarded by reputable Western companies, now repurposed for Russia's export market. The reliance on these scrapped assets exposes the system's fragility. Russia has had to build its own black market network, having lost access to legal global transport channels. The strategic rationale behind targeting the Shadow Fleet is underscored by Russia's existential dependence on oil revenue. Analysis shows that the cash flow generated by this fleet funds approximately 40% of Moscow's entire war budget. This revenue is described as a drip that turns into a river, ensuring that the war budget remains robust even amid vast economic isolation. The correlation is clear. Each successful voyage equals immediate liquidity to procure weapons, produce drones, and pay soldiers. The trade mechanism allows Russia to sell oil above the price cap imposed by the G7, effectively neutralizing the financial squeeze from Western sanctions. Since the oil's origin is concealed through the shadow network, the price cap becomes irrelevant, allowing Moscow to sell at market prices rather than restricted ones. The fleet facilitates the transfer of assets from major buyers like India and China directly to Russia's defense industry. As such, the Shadow Fleet is not an ancillary component of Russia's economy, but a central pillar of its power projection. Dismantling it would threaten the very financial foundation of the military campaign. The Shadow Fleet operates through an ecosystem built on secrecy, designed to defeat oversight and regulation. The operational procedure involves multiple layers of sophisticated concealment. A typical voyage begins with a ship docking in Russia to load crude oil, followed by immediate adjustments to the paperwork, and in some cases even a flag change mid-journey. To sever the transport chain, ships often disable their tracking systems, AIS, or conduct ship-to-ship transfers, STS, in remote, off-the-radar areas. These transfers allow for the erasure of the origin of the goods, as the oil is moved to a second vessel, which then transports it to its final destination as if it originated elsewhere. The ownership structures are just as murky. The vessels are registered with shell companies and fly flags, from small island nations or non-coastal microstates that lack the capacity or will to enforce maritime standards. Sources highlight the use of flags from countries like Gabon and Mongolia, which provide stamp registrations without verification. This legal fog allows operators to remain anonymous, shielding the ultimate beneficiaries in Moscow from direct accountability. The system relies on a chain of intermediaries, brokers, traders, and insurers who are incentivized by fees and discounts to remain silent and facilitate the transactions. The existence and growth of the shadow fleet represent a significant failure in the current international sanctions architecture. This system is described as patchwork, filled with gaps that Russia has exploited mercilessly. The G7 imposed price cap, designed to limit Russia's revenue while keeping oil flowing, relies on transparency in shipping data and insurance, precisely the elements the shadow fleet eliminates. Because these ships operate outside Western insurance markets and fly flags of convenience, the enforcement mechanisms available to Western governments are rendered completely ineffective. Attempts to modify this trade operation through traditional diplomatic or economic pressure have fallen short. While the EU and G7 have tried to impose restrictions, the decentralized nature of maritime law makes enforcement difficult. Neutral or non-aligned nations are often caught in the middle, unwilling to enforce Western sanctions due to the risk of economic disruption or political fallout. As a result, a gray zone has persisted, allowing Russia to bypass the financial squeeze the international community intended. This failure of the system calls for a shift from regulatory containment to kinetic military intervention by Ukrainian forces. Recognizing the impotence of sanctions, Ukraine initiated a direct kinetic intervention against the shadow fleet using naval drones. This marks a strategic evolution where commercial vessels supporting the war effort are now considered legitimate military targets. The operational approach combines intelligence gathering with long-range attacks. On November 28th, Ukraine's Sea Baby drones struck 2 oil tankers linked to Russia, Karos and Virat, off the Turkish coast. This was followed by further strikes on vessels like Midvolgatu on December 2nd. These attacks are no accident. They are the result of a meticulous selection process, where analysts identify ships carrying Russian crude, study ownership chains, and assess risks before launching an attack. The use of naval drones allows Ukraine to project power hundreds of kilometers from their coastline, striking vessels in the Black Sea and the Mediterranean. The goal is clear: prove that the shadow fleet is no longer invulnerable. By inflicting physical damage on these ships, Ukraine is essentially ripping the pages from the playbook of Iran and Venezuela, demonstrating that economic concealment cannot protect against physical destruction. The core mechanism of this strategy lies in imposing asymmetric costs. A naval drone is a relatively cheap asset compared to the millions of dollars needed to repair an oil tanker or the lost revenue when a ship is out of commission. This equation is described as brutal for Moscow: cheap drone, expensive tanker. The damage forces ships into dry dock for weeks or removes them entirely from operation, creating immediate logistical bottlenecks. Beyond the direct repair costs, this campaign undermines the effectiveness of the entire export system. Successful attacks force Russia to reroute shipments, increasing travel times and fuel consumption. The psychological impact on commercial operators creates friction. As the risk of shipping Russian oil rises, the costs associated with it also increase. The system, which relies on high volumes and fast turnarounds to generate revenue, begins to buckle under the strain of this persistent threat. This disruption challenges the simple formula that has kept the war going, that constant large-scale exports translate into continuous revenue. Targeting the shadow fleet with kinetic action has triggered secondary effects in global financial and insurance markets. Insurance premiums for Russian oil tankers have surged as the risk of attack has shifted from theoretical to very real. The legal fog that once protected these ships is now a liability. When a shadow fleet vessel is hit, The lack of clear ownership and valid insurance complicates the rescue and repair process, forcing operators to face enormous financial losses. Moreover, the increasing risk is forcing buyers to demand deeper discounts. Major importers like India and China are beginning to waver, seeking price cuts to offset the risks of delayed or destroyed shipments. Every additional dollar of discount these buyers extract is a dollar of revenue denied to the Kremlin. The market is now pricing in war risk created by Ukrainian drones, squeezing the profit margins that Russia relies on. Refineries are now factoring in the potential for disruption, further slowing the flow of capital into Moscow's war chest. Ukraine's campaign against the shadow fleet is integrated with strikes on energy infrastructure, creating a 1-2 punch to Russia's hydrocarbon economy. Ukraine has combined attacks on oil tankers with long-range drone strikes against refineries, such as the strike on the Afipsky refinery near Novorossiysk. Since January, these attacks have knocked out about 17% of Russia's refining capacity and reduced seaborne exports by 1/5. By targeting refineries, Ukraine is not only diminishing Russia's ability to process crude into higher value products, but also attacking the transportation network itself. This multi-pronged approach creates a choke point at the source, refineries/ports, and a threat during transportation, oil tankers. The estimated financial impact of this combined campaign is a loss of between $9 billion and $12 billion in revenue for Russia just in 2025. This comprehensive strategy ensures that even if the shadow fleet tries to adapt, the physical infrastructure required to load and process oil remains under constant threat. The physical destruction of oil tankers is causing significant geopolitical friction, particularly regarding maritime safety and environmental risks. Neutral nations such as Turkey and Egypt are deeply concerned about the prospect of oil tankers catching fire and blocking vital choke points like the Bosporus or the Suez Canal. An environmental disaster involving a shadow fleet tanker, uninsured and with unclear ownership, could result in a catastrophe similar to the Exxon Valdez spill, with no clear entity held responsible for the cleanup due to the fleet's opaque ownership structures. This risk forces foreign governments to confront the reality of the shadow fleet. While they may want to avoid escalation, the presence of these dangerous substandard ships creates a drifting liability that patience is rapidly running out for. For example, Turkey does not want a disabled vessel blocking its waterways, and India is quietly raising difficult questions as damaged tankers arrive at their ports. This external pressure adds to the military pressure Ukraine is already applying, as the diplomatic cost of hosting or facilitating Russia's shadow fleet is growing increasingly prohibitive for third-party nations.